It's not a matter of if, it's a matter of when the market crashes, and how will you be prepared for it. My name is Darius.
And I'm Carmen. We hope to share some valuable information with you today so that you can start preparing for the next crash. And when we talk about crashing, we're not just talking about the stock market. We're talking about any investment that you get involved in today.
Right. Now, the nice thing about the stock market is it's pretty predictable. Not predictable as exactly when, but we know the fact that it will happen, because if we look back over time, market crashes are pretty normal if we look at our history. Now, another nice thing about market crashes is this is when millionaires are made, because what they have done is they're able to be prepared for the next crash. And maybe that could be you for the next one.
And I think it's important for people to understand like what you mean by that. Because when you become a savvy investor and you're more in tune with what's going on in the world, you have the ability to create liquidity in your life where you can take advantage when investments dip, and you can start buying up everything on sale. You know, it's like you know, going to TJ Maxx when they're having like a store closing. You know, do you have the liquidity to go buy up whatever it is that you need? So in this video, I think it's important that we tackle one, how to be proactive in this whole process, because far too often we're reactive, and that's where we get in trouble. That's where we lose our shirt and everything else. And so we just want to make sure that you have the goods, have the assets to make sure that you can continue cash flowing.
Right. Now, you spoke of the fact that a lot of times we like to react instead of be proactive. There's a reason for that. The reason is we don't understand what we're invested in. We haven't done our research, because if we have done our research, then we're more interested in the long game rather than what's happening right in front of us.
Yeah, and also emotional, right? So our emotions are into it, like you said, the lack of education, and then we just kind of go off of what people tell us,
right,
as opposed to really taking the time to do the education ourselves.
Right. So the first point, if the market crashes, understand why you have these investments. Why is this a part of your portfolio in the first place? So that when there's a dip or there's a crash, then you understand the fact that, man, these are still solid investments for me. And just because something, because the market crashes doesn't mean that I need to lose my mind also.
Invest what you believe in the sense of, you've done your research, you back it up personally. And again, it's not just because someone told you, oh, this is a good investment, you should put some money on it. You never do that anyway. So why do we do that with our investments? We take significant amounts of money and drop the bag, and then hope that everything works out without having any literal due diligence on our stand. Right.
And if you're investing in stocks because it's what somebody told you, then that's probably not a good way to spend your potential retirement, your portfolio money.
And even with stocks, it could be real estate as well, right? Because we know many people get involved in real estate deals because the return sounds good, but then they don't have an exit strategy in place. They don't even know who they're dealing with. They just know that, you know, somebody promised them the world, and that they don't know what's going on. And that's where we get in trouble. So that's why we said the very first point, it is imperative that you know what you're investing in and that you believe in it, and you have enough education where you understand why you've invested in this thing in the first place. That is the basics to what you need to be able to do when you're getting involved with any investment.
Right, because if I was to think of the market, just stock market in general, the stock market is there for the long game. But I think with the fact that we have so much technology at our fingertips to where we can do different things, where we can buy a stock from our cell phone, we can sell a stock from our cell phone. We're looking at it as short term, but short term investments are for the day traders, and the average person shouldn't be day trading.
Yeah.
You should be doing your research and sticking to your guns, and making sure that in the event something does happen, you can't let that divert your decision to do something differently.
And I think also too, I don't know if you think about this, as you were just saying that, I was like, I wonder if this is the case. So tell me what your opinion is. The reason why people aren't, generalization, let me preface, it's a complete general statement. I wonder if the reason why people, when they get involved in the stock market, don't commit to the long game is because their finances, they can't afford to commit to the long game. You know what I mean?
I see.
It's like pulling from your 401k, continuing to borrow from your 401k when you don't have the savings in place. I wonder if that's also something that happens when it comes to investing, which is why we tend to be reactive in that case.
Right.
And more specifically, what I mean is with any investment, sometimes we tend to pull out early because we need cash. And what we've seen with just, whatever happens in the economy, sometimes we might be having a down year, a down month, whatever it is, and we need liquidity. And we don't have that liquidity separate from our investments, because traditionally, again, a general statement, what we tend to do is just take our savings and invest it, but we don't have liquidity on the side to cover us for the resources that we may need in the future.
Right.
So then we have to pull from stocks, we have to pull from our 401k, we have to pull from our real estate, we have to take a HELOC, whatever the case may be, because we don't have the savings.
Right. Yeah. I 100%
Does that make sense?
agree. Yeah, 100% agree. And the fact of the matter is there needs to be a process in which you get to the point to where you're investing.
Yeah.
And the first stop before investing is going to be savings. So you want to make sure you have 3 to 6 months or even 12 months, but because of what we just experienced recently, you may want to have 12 months of savings. So in the event that your portfolio does take a small hit, we're going to say a small hit with some type of market crash, then you won't be so pressed.
It's not going to affect your household.
Right. And it's not going to affect your health because you're so worried about the fact that the market's going down and you're could be having some issues in your investments.
Mm-hmm. So while you're stacking that bag, right, that what you should be doing in the instance is educating yourself and making sure that when it is time for you to invest, that you have the education and you're confident with where you're going to be placing your money.
Yeah.
Because that's the other thing too, is sometimes I feel like people respond to comments and they say, hey, Carmen and Darius, or they get down on themselves because they're not ready to invest, or they're not in the right position financially to move to the next level. And that's totally fine. We don't ever want people to be in FOMO, to fear of missing out, because everyone is going to start at different places.
Right.
But the point is to recognize that the end goal is to be an investor so that you can create cash flow. You just have to respect where you are in the game right now and know that you have to build on it.
Yeah. Yeah. Now, I mentioned earlier the fact that if the market crashes, there should just be a small dip in your portfolio. The reason why I say that is because when doing your research and doing your investments, you have to always remember to diversify your portfolio across different asset classes. Yeah. The reason why that's so important is so that you don't have all your eggs in one basket. So, for example, if you have all your investments in the stock market and the stock market crash, then you lose a huge chunk of your investment. Mm-hmm. It has to be diversified across stock market. It has to be diversified across bonds, hard assets, fixed income is bonds, real estate. Mm-hmm. You really have to. Commodities, you really have to take in consideration your asset class diversification so that when one market goes down, it doesn't kill your entire portfolio. It'll just be a blimp as far as your portfolio is concerned. And
this is something that I just don't know if people truly understand from different avenues. I feel like diversification is a word that's like out there that everyone knows, diversification, but typically, again, general statement, I feel like diversification is something that's always related to like the stock market, for example. And it was something that we had to learn, and it was something that we had to create within our own portfolio. And what that means to us is just understanding what are the asset classes that are out there and how can we get involved? Because again, we had to do our own research. Commodities wasn't something that we came out of the gate thinking that's what we wanted to invest in, but we know that we have to be diverse in where we place our money. So now we got to start educating ourselves on commodities and understanding what makes sense for us, not what our neighbor said, not what our mom and daddy said, but what makes sense for us. And we have to personally guarantee that, not from an investing standpoint, but just for understanding that we're okay with where we're placing our money. Right. And with the whole diversification thing, like we can't stress that enough, because again, if we're trying to be proactive and not reactive, we have to be able to place our money in different areas so that as the market is seesawing, we're not going to be as affected because we're more so in the middle of that seesaw.
Right. Because here's the thing. I think what happens also is the fact that when one market crashes, maybe another one goes up,
Yeah.
and there's an opportunity there.
Yeah.
Or if we don't have any cash, which is a asset class in itself, if we don't have any cash, we can't benefit from the fact that things went on sale.
Yeah.
Because I mentioned earlier the fact that millionaires are made when there's a crash is because they have prepared for it. They've done their research, they've prepared for it, and understand that this is something that happens frequently, and they're able to buy the difference. They're able to buy what's on sale.
Yeah.
The most important thing we have to take from this is the fact that we are able to benefit from we make the most money from the purchase rather than the sale. So if you're selling your stocks, as an example, if you're selling your stocks because the market went down, then your purchase wasn't good. You purchased it at the top of the market because everybody else was buying it. And that's not a good way to go about investing for your future.
Now, the other thing too is with this whole process, because basically we're talking about, if the market crashes, what do you do?
Is when the market crashes.
And it's when the market crashes. So that's why with what we're sharing with you today, it's important that you take note and you start working on these things today, because as we know, many people lost a ton of money back in 2008. And then we kind of got desensitized. Enough time has passed where maybe we're all getting back in the market again. We're all believing in our retirement accounts again. And then, history at some point is going to repeat itself. So we keep going in these ebbs and flows of the market and what's happening. But we continue to go, woe is me, I lost my money. And what am I going to do? So we want you all to continue to learn from what's happening and moving forward, so that when there's a dip in the market and whenever investment that you get involved in, you have a plan in place.
Yeah, I had an economics professor tell me that when markets crash, it's a good thing because it separates the experts from the tire kickers. Because what happens is when things are going good, you have mom and pop, or not mom and pop, you have the average Joe just throwing their money at something and everybody can win. And when a market crashes, it separates those people, and we can get a good idea of exactly where we are in that particular market. So it's a different perspective that he gave me years ago. And I think with understanding the fact that there's seasons and cycles in our market, that may be the case, because I even go back to real estate. In 2008, you could buy entire neighborhoods in Arizona. Yeah, there's in Houston. You remember that? There's entire neighborhoods that were just empty.
Yeah,
and you can go in and buy these houses for pennies on a dollar, but there wasn't enough people there that could buy all of the inventory that was available. And what happened is the fact that all these people spent their money on the top end of the market. They spent their money on the top end of the market, and when things happen, which they always do, they weren't prepared for that dip.
Yeah, no, I agree with that. And going back to, again, knowing what you're getting involved in and why, and even what's going on now with the real estate market, how there's a huge bubble, and people are continuing to buy real estate or even cars. We know that they're at the top of the market, but for whatever reason, we're still, as consumers, going out and buying these things and going into bidding wars when we know that this isn't the best opportunity for our money. So that's where, again, we have to be savvy investors and understand what are we getting involved in and why.
Yeah, well, I think we're using a different mechanism for these purchases. We're using our emotion instead of our brain, our intelligence.
Absolutely.
For these particular purchases.
Absolutely.
Now, the next thing, I mentioned the fact that people are prepared to buy the dip. That's the third point, is you have to be prepared to buy the dip, because again, you're able to make the most money on your purchase, not on the sale. So when the markets dip, you have to be ready for it. And that means you might need to have a little bit of cash on hand so that you can take advantage of it.
Yeah, a little bit of coin.
A little bit of coin is important.
That's what I was thinking about. I was like, a little bit of coin. Because like you said, when we were living in Houston and then transitioned to Phoenix, we saw literal neighborhoods just going up. And at that time, we didn't have the coin to buy up the neighborhood. But we were like, man, if we could get our hands on this. And if we knew a little bit more about investing, we could have, used a third party route and gone that way. But anyways, I digress. The point is to not only have the coin We continue to say education. Did you not hear education like 72 times on this video? Because again, what I was just saying, if we understood creative ways of financing, realizing that we didn't even have to come up with the cash for ourselves for different investing plays. But it is always important that you do have some sort of strategic play with liquidity so that you can buy up whatever market goes on sale. And now, that's where the wealth transfer happens, is because people are buying things on sale and the assets do eventually appreciate.
Right. Now, what I do want to expand on is the fact that you say you don't necessarily need your money to make these investments, but you have to have some expertise in order to get those funds. You have to be able to show that you are going to be able to make educated decisions with the funds that you do have. And you may not necessarily need money, but you do need leverage. What are you going to leverage in order to get those funds? Because you always have to put up something.
Yeah.
What are you going to be able to put up, and what are you going to be able to show? What portfolio will you be able to present to the person giving you the money that you're going to be able to make good decisions with with the income that you do receive? Because I think a lot of times we say that and we mention that, but we don't give any context to it. And what I want everyone to understand is the fact that there is money available out there. You just have to be good at asking for it. And being able to ask for money is a
skill in itself.
A skill in itself, because you do have to show some reason why somebody wants to give you $100,000, $200,000, $300,000, $400,000. It is available for that.
Yeah. And then also you have to understand how collateral works, right? So you can't just ask for money and not have any backing. Right. So whatever you are investing in, it has to be a legitimate enough asset where there is some sort of collateral in place. So I'm glad that you said that disclaimer, because we never want to say something and then people go out and be reckless. You do have to understand the power of leverage and not take advantage of it, because once you do understand the creative ways that you can invest in this world, it's just about how do you keep doing it, and how do you 10x it, and how do you continue to make it where it's a mutual beneficial relationship between yourself and the investor.
Now, the fortunate thing for you about all these things that we're talking about is the fact that you have a supercomputer in your pocket, which is your phone. You can look up all this information and start educating yourself around the position that you're going to play. There's books that you can read that can help you better prepare yourself as far as educating yourself on the position that you want to play. You have to figure out what your position is going to be in this market or in this whole idea of this money game, because it is a game, but you have to understand your position and how you play it.
And I feel like we need like some sort of ticker on the screen where it says how many times we said education, because the rule of thumb,
education is free. Also,
it is, especially these days.
Yeah.
You know, you don't need a library card. You can just use your phone. But the moral of the story, when we go back to all of this, is if the market crashes in any investment, whatever it is that you get involved in, there shouldn't be a shock. And what I mean by that is, like, on your part, there shouldn't be such a shock where it's like, what do I do now? And if that's the case,
you haven't been prepared.
You didn't prepare yourself and you didn't educate yourself, because you should always understand the moving parts and knowing, you know, what leverage you need to pull over here or over here, so that if things do tend to shift and change, you're prepared for it. So that's why we want to make sure, again, for those of you watching our videos, that when you invest, it should never be what is your risk tolerance. You should never be having those conversations, because risk just means that you haven't educated yourself and taken the time to understand what it is that you're getting involved in. That's risk tolerance. That's really what risk tolerance is. But if you understand what you're getting involved in, there shouldn't be any risk that you're taking on, because again, when you think about the wealth transfer and the wealthy people who are investing, they can't afford to have risks when they're investing millions and millions of dollars. There is always a strategic play. So we never want you all to feel like you shouldn't have a strategic play either, and that your money isn't as valuable as those who have more money than you do.
Right.
Because you always have to start with what you have.
Yeah, and I like the idea about risk, because when they, whoever you're giving your money to, tell you or ask you about how much risk you're willing to take, they're asking you how much of your money you're willing to depart from and be okay with, because they're not going to be taking any risk with their money. They're going to get paid up front. you're the one that's going to have to worry about the risk in which you are giving up control of your money so that somebody else can do it in hopes that they can do a better job than you.
And you have to think about it too. I think we've said it on a previous video where you mentioned it,
We probably
Darius,
did.
where you were talking about if you're the one who's working so hard and you don't even like what you're doing in the first place, why are you okay with just throwing the money that you worked for, that you hated what you were doing to get it, and just throwing it out of the window? You know, like you have to think of your money from a different perspective and recognize that you got to put some respect on it. You got to treat it a different way, and that it has to come back with friends in every opportunity possible.
Right. Right. So the three things that you should do when the market crashes is you need to make sure that you've done your research and understand why you picked your investment in the first place. The second thing you need to make sure is that you've diversified across different asset classes. 5 major asset classes is, of course, cash, fixed income, real estate, commodities, and then our equity, which is stock market.
Absolutely.
And then the last thing is you make the most money from the purchase. So be able to benefit or be able to be prepared to buy the dip, because that market is always going to go back up. It's always going to go back up when it goes down. It's something. It's a cycle. It's a season that happens over and over and over and over again.
Absolutely. So remember this. This is very, very important. And then also, if you want to start understanding diversification, what that looks like, then what we want you to do is check out our next video where you learn about all the asset classes that you should be investing in.
Remember to own your own lifestyle.
Or someone else will.